I've structured over $2 billion in acquisitions and acquired over 15 companies. I'm going to show you the fastest way to make $10,000 a month. It's not starting a business, it's from buying a business to get started. Most people think you need hundreds of thousands of dollars or even millions of dollars to acquire a business. Actually, in my 30-year career, I've acquired companies generally much less than that using seller financing and other tools and techniques, which I'll explain in this video. In fact, 60% of all the acquisitions use seller financing, which means the seller acts as your bank. Here's what most people don't understand. When you buy a business at 3 to 4 times earning, the business is going to pay for itself over 3 to 4 years. You're buying a business where it's paying it back. That's the way to go. The demographic opportunity is unprecedented. Baby boomers are retiring in record numbers, and 40% of them don't even have a plan to sell their business, which means they desperately need buyers like you. In the next 10 minutes, I'm going to show you exactly how to structure deals with no money down, and because this is the solution they're looking for. They want to sell their business and you want to buy it. There's a massive wave happening right now that most people don't see coming. 10,000 baby boomers are retiring daily. We call that the silver tsunami. 75 million baby boomers own 50% of all the businesses. 40% have no succession plan. Kids don't want the businesses. That's probably not a surprise. Employees can't afford to buy it. And this creates desperate sellers from the baby boomer generation that need creative solutions. They need buyers, they want to retire, and here's what we're going to do. We're going to help them retire by buying their business. 25 to 2026 is the peak opportunity window. That's this year, next year, and maybe the next year or two after that. You need to be in a position to act on this because some of these deals are not going to be around long. But even knowing that this opportunity exists, there's one massive roadblock stopping most people. That's usually themselves. They are just not ready to act. They haven't been told how to do this. Let's go through some of the myths and things we have to get rid of so you're going to be in a position to actually take advantage of this huge opportunity. Number one, the biggest lie I've been told about business acquisitions. You need huge amounts of money, hundreds of thousands of dollars. Reality, you don't. Between the SBA loans and seller financing, you can generally get into a business with 10 to 25% cash comfortably. Sometimes much less than that depending on the business. And remember, you're only paying 3 to 5 times for that cash flow. Private equity uses much more leverage than this, and they've been very successful. We're just copying their playbook to some degree. We're just doing it in our space. Your job isn't to have the most money at the table. Your job is to get the best deal. There's 4 financing methods that we can get into. It's SBA lending, bank lending, the seller financing either with a note or an earnout or something of that kind of constructive nature. They might be a consultant, they might stay on the job. And the other one is bringing in partners or bringing in some outside capital to help you. And there's plenty of outside capital available for a good deal. The next thing I want to talk about is the 4 financing methods. We just went through it a little bit, but cash, it's the least recommended. You want to put up enough cash that you make the loans there. You want to keep enough cash around that you've got working capital and the ability to get over the little speed bumps that are going to inevitably happen. You want to make sure that you've got your personal expenses covered as well as enough working capital in the business. The SBA loans, which they just recently tightened this up, the SBA defaults had gone up a little bit, but by tightening it up, it just makes the prices come down. And that's what happens in this space. As you put more money into it, the valuations will go up. So this is actually a good thing for a buyer. We're going to have better valuations 3 to 4 times rather than 4 to 5 times cash flow. The seller financing has all different types. You can do long periods of time. You can make it contingent on the business having certain revenue targets or something similar to that. There's ways to be constructive. If you have a good advisor, they'll help you structure the right way to buy the business and reduce your risk. You can bring in an outside investor. There are search funds groups, there's capital pools, there's marketplaces, there's an entire universe and ecosystem around supplying capital into these businesses. They're very attractive. The Stanford search study results, which they publish, I believe it's every year, but the last one I saw was a few years ago, was an average of 31% internal rate of return for investors in this space. These deals work, and so people will give you money and be a limited partner in your deals. You can also put all this together and make sure that between that and getting the seller to reduce the price or whatever, you're going to get a good deal and a good transactional structure. Combination of SBA or bank debt, seller paper in some form, and possibly some outside capital, and you can buy a much bigger business than you probably think you can today. So now I want to talk about the financing method that's used in at least 50 to 60% of all the small business acquisitions, and most people really haven't utilized this fully. Sellers will almost always help you buy their business. How? They'll work with you. Part of that is building a relationship with them, but once they trust you and believe in you, and they know you're bringing in some cash, you're going to be in a position to ask them to help you finance the deal. That can be a lot of different ways to go here. Sellers will act as the bank in an unsecured fashion, and they might ask you for a guarantee or some security, but generally they're going to be behind the bank who's sitting in first position. Sellers get to defer their gain on sale over that period of time as they get the payment, so they have a tax benefit for this. It also gives them a retirement stream if that's what they're doing, is retiring. They're going to know they're going to get those payments over time. And remember, you're using the business to make those payments. It's not coming out of your pocket, it's coming out of the business that he sold to you. This actually closes quicker than going out and getting an SBA loan or something else. Those can take 3 to 4 months on average. Banks can be a little fickle. Sometimes they're going to do it, sometimes they're not going to do it. And the typical seller note terms are usually between 10 and 30% of the purchase price, and I've seen deals at 100% of the purchase price. It really depends on the business and the situation and how much competition you have for that business. The interest rates that the sellers charge are very competitive. In my experience, and all the seller notes I've done, they've been substantially less than the banks were charging me for the same thing. So, for example, I just did a deal. I'm paying the seller 8%. The bank money, and if I use SBA on it, it's going to be 9.5%, 10%. The seller paper is cheaper than the bank paper. Typically, you're going to be able to do this over 5 to 10 years. 10's a little bit long. The SBA requires 10 if you use an SBA loan, but 3 to 5 to 7 years is the norm for sellers to agree to carry that over that period of time, and that's a comfortable payment schedule for you. And typically the first year, I'll ask for no payments or interest only, and won't start any kind of principal amortization. And even then, we might amortize the principal over a longer time, like 10 to 20 years, with a balloon payment due at year 5, 6, 7, and by then you've either refinanced, paid it off, or sold the business. Let's talk about the SBA. The SBA came in and created a couple of programs 15, 20 years ago that really made this take off and made it available for banks to do small lending in a profitable way, because the government is basically guaranteeing against the majority of the default. 90% of it, the government's taking. The government guarantees that 90%. They do charge a couple of points, but that's not your problem. What you want to do is use the SBA in a smart way. If you're going to do the SBA process, you want to get pre-qualified. You want to work with a good broker. There's many of them that are out there that do a really good job of shopping it among different banks to get you the best deal. The full standby guarantee that the new rules came into, suffice it to say that the sellers are going to probably not want to continue to carry and be part of it, because if they own more than 10%, they're going to have to guarantee the loan. And I don't know many sellers that are going to guarantee a loan that you're going to use to buy their business. But the banks really like the SBA lending. They get a lot of fees, they have no risk, they don't have to put up any capital, and they get the banking relationship with the business, all the cash flow and the payroll and everything else that goes with it. So here's where it gets kind of fun. You get to structure this any way you want. So when you have an advisor, your attorney, all the people involved that are helping you do this, you're going to sit down and figure out what you want to do. It starts with the cash flow of the business and making sure you've got plenty of coverage to make sure that the cash flow is servicing the debt that you put on the business. And what you want to do is make the seller portion of that somewhat tied to the results of the business. Why? Let's say you get there in 6 months and something happens, they lose a major account, something goes down, and you have a bad quarter, you're not going to have to make that payment on the seller. And in some cases, you get to claw it back and actually don't have to make even the principal payment down the road. Just all depends on how you structure that deal up front. So structuring is where you're going to create a lot of value. Something else I want to talk about, how do you find these deals where you get a seller doing that? First of all, they're going to tend to be on the smaller side. Anyone who's doing $5 million in revenue and up is more often than not going to be selling to some version of a family office or private equity firm that has plenty of capital to come to the table and is going to want a lower price in exchange for an all-cash deal. We're talking about generally our businesses under $5 million in revenue, where the sellers know they're going to participate in that structuring and help the buyer put the deal together by carrying some of that. And again, it's going to range from 10 to 30% on average, and I've seen it as high as 100, but generally I don't see it go over 50%. But I would say 30% is your target. You want to try to make sure the seller's carrying 30% with some ability to offset that if something goes wrong and you're not able to make those payments because of something that happened in the business. The kinds of businesses you want to focus on are going to be the kinds of businesses that are a little bit harder to sell. So if they have customer concentration, if they've got outdated technology, poor marketing, maybe some employee turnovers or reliance on one employee. Those are all the reasons that you bring up with the seller in structuring the deal to say that you need some comfort and protection against the downside should something happen. They're going to understand that, and they're probably have heard that from a few people that have passed on the deal, and that's the best time to put this on the table. Many sellers think they're going to get all cash. If they have a good broker advisor, they're probably going to educate them on that's not likely going to happen, but they go into it with that expectation. However, after being turned down a few times, they're pretty receptive to taking some kind of seller paper, earn out, something that's going to help finance a lot of that purchase price, roughly about a third. What you want to do when you're having that conversation with a seller going through this is give them the benefits about why it's good for them to do this. First of all, they're going to get more for the business over time. Just the fact that they're going to get some payments over time, including some interest rate, a return on that, means that they're going to get more for their business than they would if they did try to sell it for cash. It's also going to close faster. By having them draft the note and being part of the financing rather than using an outside bank or third party like the SBA, you're going to end up with a deal that's going to close faster, and the seller is going to be more interested in your success because they want to get paid the rest of that money. So you're positioning this as a win-win with the seller, and you can show them that with the tax benefits, greater proceeds over time, alignment of interest, all these things are real, and most sellers, when you develop a relationship with them and they trust you, are going to sit down and work that out with you. So when we talk about what kinds of deals you're going to do and the due diligence and the risk management side of this, you're going to bring the seller paper up in the middle of the conversation. You might have submitted a letter of intent to get into the due diligence that had that concept in there or not. It's okay in due diligence if you find something that gives you a little bit of concern to go back and change the deal terms to include more seller consideration in paper. You can say, I could reduce the price. I'm happy to keep the price the same, but I need you to take this amount in exchange for me taking on this risk that may happen, which you acknowledge as a seller is a legitimate risk. Generally, it's often tied to a large contract or customer or someone sticking around that they don't have a contract with. And they're going to understand if they stay around, you as the buyer did better, they're going to do better. If they left, then the price was too high and therefore it should have come down and the seller note's going to get reduced. That's the structure you want to have here. So where are we? So we've gone through the process of what's involved in financing a deal, why the seller should want to do this for you, how you can go buy a business that is probably larger than you thought you could do, and how you can go out and finance it using several different ways, including some outside money, bank, SBA, and seller paper. Now you got to get started. You're going to find motivated sellers. You're going to find sellers that will take paper that will help you get the deal done. And that's going to give you the comfort and the ability to keep some of your cash in your personal accounts, not have to use all of it to go get this transaction closed. And if you want to avoid these pitfalls and have somebody guide you through this process, you can click the first link in the description here in the notes. And if you like this video and you found it valuable, please share it with somebody, please like it, and we'll keep doing more. Thank you.